Hey guys, it's Hamish here and we're back. In today's video, we're going to be doing another earnings reaction. Today, we're going to be looking at Facebook and their full year 2018 results. This is another big one. Yesterday we had Apple, so if you haven't seen that, go check it out. But today we're going to be having a look at Facebook, and this is just as important as Apple, if not more important, because I do have a small position in Facebook. Now, it is a speculative position. So it's a very small position in my portfolio, and I don't think that it's possible to accurately predict where Facebook will go over the next 5 or 10 years, but it is still interesting to see what they are doing and to see if they're performing how I expect for that proportion of my portfolio. So if you do enjoy this, make sure you leave a like and let me know what companies you want to see me react to down in the comment section below. But for now, guys, let's jump into it. All right, so Facebook reported their full year 2018 results, and of course with that comes their fourth quarter 2018 results. So we're gonna go through the fourth quarter first, and then we'll talk about the full year in just a second. So in terms of the fourth quarter, they had revenues up 30% year over year to $16.9 billion. They had net income up 61% year over year to $6.9 billion, and EPS was up 65% to $2.38. That is just an amazing increase in terms of profits and earnings from the fourth quarter of 2017. However, a large part of that is just due to the fact that in the fourth quarter of 2017, we had a different tax code in the US. So in the US, there was different tax laws. And then at the start of 2018, corporate tax rates were changed dramatically. And Facebook was one of the companies for which tax rates changed a lot. And by a lot, I mean in the fourth quarter of 2017, the effective tax rate was 43%, and that is now down to 14%. So their tax rate has dropped from 43% down to 14. And as a result of that, their earnings increased by 61% in terms of net income, and their earnings per share increased by a whopping 65%. However, if we just sort of forget about the tax cut, not that we should forget about it, but if we just exclude that and have a look at their operations, their profits from operations, their net income from operations only grew by 6%. And the reason for that was because there was a 62% increase in operating expenses. And this is mostly due to, again, security and safety costs that have increased dramatically. They're taking on more staff. They have about 30,000 people staffed there compared to the 10,000 that was there before all of this happened. So they've increased their staff. They're increasing their infrastructure and spending on infrastructure, and as a result, their profit in terms of their operations didn't grow too much from the fourth quarter of 2017. So let's let that lead us into talking about the full year 2018 results, because this is ultimately what is important. How did they go for the whole year of 2018 compared to the whole year of 2017? So in terms of revenue, they had revenue that was up 38% to $55 billion. $55 billion of revenue. Again, we spoke about this with Apple bringing in, I think it was 85 billion or something like that. It is a crazy amount of money that these companies are generating. Apple generating it through their products and services such as their iPhones and their Macs, and Facebook generating it through business advertising on their platforms. It's incredible that these companies can generate such large amounts of money in terms of revenue. In terms of net income was up 39% for the year to $22 billion, and earnings per share was up 40% to $7.57. Now, this is just absolutely amazing growth. So remember, we had huge increases in expenses. For the fourth quarter, the increase was 61% for expenses. For the full year, the increase was 51%. So a massive increase in expenses, but they're still able to grow their earnings by huge amounts. 40% is a huge amount to grow earnings by in a year, especially for a company that's trading at a PE of around 20. So then any smart investor would want to answer the question, where did this growth in revenue come from? So growth for revenue for Facebook came from two separate places. The first place is that they increased the number of people on their platforms in terms of the number of people using their platforms daily. and the number of people using their platforms monthly. Daily active users and monthly active users increased by 9% year over year, which is really impressive actually. And that's in December. So the December period 2018 compared to the December period 2017, there's been a 9% increase in the number of people who use their platform. So about 6 months ago, there was a lot of concerns about the fact that people think that Facebook wasn't going to grow anymore at all. And the fact that they have 2.32 billion people using their platform every single month. And the fact that not only do they have multiple billions of people using their platform every day and month, they're still growing it at close to double digits, which is extremely impressive for a company of that size. So because there's more people on the platform, there's more available spots for advertisers to advertise, and that increased the amount of revenue that they could bring in. Now, the second way that they bring in revenue is by how much each ad costs to put in front of one of those users. So even though the number of users is slowing down, it's not growing as fast as it was in the past, even though 9% is still impressive. What drives the revenue that these companies bring in, like Google and Facebook in terms of revenue, is how much businesses and other people are paying to advertise in front of these people. So you should really think about Facebook and the number of people on Facebook as real estate. So the more people that are on Facebook, the more real estate there is, because every person who's on Facebook every day has a feed, or has like an Instagram feed, or has some kind of place where Facebook can put an ad. So there's more real estate if there's more users. Now, because that is slowing down, the amount of real estate available for businesses to advertise in front of, in the people that they can advertise in front of, that's slowing down, which means that as demand for advertising increases and the amount of real estate stays flat, the price that businesses are willing to pay for that real estate also goes up. And the amount that advertisers are willing to pay to advertise on the Facebook platform is going to continue to go up. And that is simply because advertising on Facebook is a lot cheaper than it is to advertise in other means, on TV, in newspapers, and to advertise in Google. And I'm not just talking about the direct cost to advertise. I'm talking about the cost to advertise relative to how many customers you acquire or how many sales you make. Facebook has the best advertising platform by far. And that's because you can target specific people with specific interests, liking specific pages, specific ages, genders, whatever you want. You can target them. And for that reason, you can get very, very effective ad campaigns that may cost you a very small amount in order to acquire that customer. So as long as Facebook can at the least maintain their audience of over 1 to 2 billion people, then advertisers are going to continue to pour more and more money into advertising on Facebook because it's just cheaper. And more businesses are figuring out that they can do this. A lot of small businesses and even massive corporations don't advertise on Facebook at the moment, and they will in the future because it's cheaper. And once they figure out that they can do this, ad rates are going to go up, and they can go up quite a lot, and that increase will massively increase the amount of revenue that Facebook can bring in. And lastly, on the numbers, free cash flow for Facebook was down 12% in 2018. And again, that's just due to a massive increase. I think it was about a 50% increase in capital expenditure, which was mostly due to increases in security and safety infrastructure. So now let's talk about valuation, and we're going to talk about relative valuation as well as have a look at absolute valuation with my value matrix. We've updated it and we'll have a look at what the numbers are showing us. But just to start with relative valuation, and what I mean by this is right now compared to last year, what is their relative valuation? So how is the price moved relative to what the company has actually produced? And when I mean what has the company produced, I'm talking about how has their equity changed, the real value of the company in terms of their assets and their liabilities. How has that changed in the last 12 months relative to the price? And also how has their earnings changed, their earnings power changed in the last 12 months? So we'll start with equity. Now, equity grew at 13% in the last 12 months. So the book value of the company has increased by 13%. Also in that time, the stock price for Facebook has grown by 15%. So what this means is that the core value of the company grew by 13%, but the price you have to pay for that grew by 15%. So in terms of equity, relatively speaking, Facebook is actually less attractive than it was 12 months ago in terms of equity alone. But if we then have a look at earnings per share, now earnings per share, as we just said, increased by 40% in the last 12 months. And of course, again, Facebook's stock price increased just 15%. So in terms of earnings power, the valuation of Facebook has become a lot more attractive than it was 12 months ago, because 12 months ago they were earning 40% less in terms of earnings, but their stock price was only 15% less. Now you've got 40% more earnings power, yet you're only paying an extra 15%. So relatively speaking, in terms of earnings, it's a lot better, but in terms of equity, it's not that much better. It's about equal to how much the stock price should have moved relative to the change in equity. So that sort of brings us to do an absolute valuation. So let's have a look at Facebook in isolation and see what kind of growth projections we can make and see how much money we would make on this stock based on the different prospects that Facebook could have over the next 5 years. Now, it's definitely too early in Facebook's lifetime, in the company's lifetime, to accurately predict where they're going to go in the next 5 or 10 years, which is why it's good to use a value matrix to give us a range of different outcomes. Once this company settles down and has very consistent earnings for 10 or more years, then we can look to the next 10 years and say, it's going to be in the same ballpark region, but for now it's growing rapidly, so we have absolutely no idea. And that means that we're just going to be very conservative. It means that we're going to use a wide range of growth values, and it also means that we're only going to be making small speculative positions rather than making a massive 15 to 20% of our portfolio investment in Facebook. So I've updated the trailing 12 months EPS to be $7.57. We're still looking 5 years out. And I just wanted to show you, so about a month ago, the price of Facebook stock was $125 per share. And this is what the value matrix looked like. This is what happens when a stock gets absolutely beaten down by everyone in the media and on Wall Street. This is what it looked like. It was to the point where even if Facebook just grows, if you bought it at $125 per share 1 month ago, it was like the 20th of December, and then from that point, Facebook grew earnings at just 5% per year, and they still achieved a PE of 20, which is what they've got right now. It's below the market average for average companies, not even talking about high growth companies. Then you would have made a 10% return. You would have made an almost market average return, which is pretty insane. If you'd bought at that price and then they go on to grow earnings at 10% per year for just 5 years, and let's say they had a PE of 25, then you would have made a 20% per year compounded return each year for those 5 years. That's 2.5 times your money in 5 years' time, which is insane for only 10% growth. Even at the current stock price of $167 per share, at 10% growth and a 25 PE, you'd still make almost a 13% return, 12.79% per year. And remember, this is a company that just grew earnings per share at 40% for the year and 66% for the quarter. So if you were interested in Facebook, then that was the buying opportunity right there. And I think that even at the current levels, as a small speculative position, the price honestly isn't that bad, although it's really not ideal to buy after it's just had a 10% increase. You really want to have the discipline to buy when it's going down. Like when I made my first speculative investment, my only speculative investment in Facebook, it was immediately after it dropped 20% in a day. After their earnings, I think it was in July, about 7 months ago or something like that. And at that time, the price was about $175 per share. So I didn't add more, and the reason I didn't add more is because I'm keeping it as a small position in my portfolio, a very small position, because like I said, I have no idea where this company is going to go. But even for me, who bought at 175 and am still down a little bit on the position, Facebook itself bought back $12 billion of its own stock when it was low. So that means that even though I didn't buy more stock, Facebook did it on my behalf, and for that reason, they're going to make a substantial profit on the $12 billion that they invested in their own stock. they've already made 30% on it, and it's very likely that they'll make 15 to 20% on that. As I just demonstrated in the value matrix, they'll probably make 20% on it, even if the company only grows at 10%. So that's all I had for today, guys. I hope you enjoyed my sort of breakdown of Facebook's earnings. Leave a like if you did enjoy it, and let me know your thoughts down on Facebook down in the comment section below. And of course, let me know if you have any other companies that you want me to sort of break down in this earnings season. But I hope you guys have a great day, and I'll see you in the next one.